makes it a little bit interesting to look at. And so I went through the process. Okay, oops, excuse me, bless you. Right, I did the Seeking Alpha thing. I got United Airlines on there too, but if I go to the Seeking Alpha, just to give you guys an idea again, hit the search thing, P&G, their ticker symbols, just PG, boom, okay. Then I come down to the SEC filings, and I really like this on Seeking Alpha. I'm looking for their annual report, okay. Annual report's going to be 10K, okay. Quarterly reports are 8K, okay. And, I'm sorry, 10Q are quarterly reports, I'm sorry. 8Ks are other information that they submit. Okay, if there's some weird changes and stuff that happens, they have to submit other, could be insider trading that they might have to report, different things like that. So those are 8Ks. So I'm looking. What, insider trading? But but you're not prohibited from buying stock in your own company, right? Okay, there's nothing that prohibits you, but sometimes you have to disclose that, and then it's not insider trading, and that's what the 8K would be about, right? If I owned a bunch of stock in my XYZ corporation, and I'm the CEO of XYZ corporation, and I decide to sell some of that stock, okay, I probably need to file an 8K, and I tell them, I'm gonna be selling some of my stock. Boom. Then this is why. Usually I think you have to give an explanation. But then I hit the 10K, right? And I've got it up here. So, just so I know which page to come back to, page 17. When I come to the table of contents, you know, it starts here, management's discussion and analysis, financial conditions and results. That goes from page 12 to 32, okay? A lot of what you're gonna be looking for is maybe gonna be in there, okay? And in my case, I scrolled down and I got to 12, and the first part of 12 was a lot of just disclosure stuff. Then there's 12, right? First, it compares itself, which is all right. But this is disclosure stuff, forward-looking statements. Basically, they're just saying that, hey, we make some forward-looking statements, and you don't have to pay any attention to those because sometimes we don't know what the heck we're talking about, et cetera, et cetera. I come down, you know, sometimes this is maybe worth looking at. They might have some things like this. This breaks it down by segment. But in their case, I got down to here. I just kind of kept scrolling down. We got this summary of 2022 operations, and most of yours will have something similar to this, right? And this gives me, I say that I want you to tell me what the numbers are and whatnot, but I also want you to tell me, you know, why the numbers happen. You know, give me a little bit of background. In this case, you know, net sales increased 5% to 80.2 billion, okay? On a 2% increase in unit volume, so what's that mean the rest of the increase was attributed to? Price increases then, right? Have to be, right? But unfavorable foreign exchange had a negative 2%, okay? But I come down, I'm kind of skipping some stuff. I get, just to try to get to the important stuff. Organic sales increased 7%. So what do I mean by organic sales? You guys know what that is? Okay. Organic sales are the sales that you generate from within and from what you already own, okay? So that means that they might have had organic sales increase, but maybe they bought something or acquired something that might have actually been a little bit of a decrease or held them back a little bit, okay? In most cases, if you'll see net sales increased a bunch, and maybe it's because it's acquisitions and not organic sales, but they should break that down, okay? Now, this is just 1 year, okay? If you went through each year and you started to write out, you know, what happened each year in terms of their sales and whatnot, you'd take 20 pages to write me this report. So what do I expect you to do? Maybe look at all 5 years and kind of summarize it then. Or again, point out, well, you know, they had normal sales, you know, grew, you know, 4 to 6% organically, but except for maybe 2019, sales were vastly decreased due to COVID, right? According to management, boom, you got it, right? Okay. So those are the types of things that you can kind of look for. And then remember, I always look at other things. You know, operating income decreased by a little bit, okay? But still, we don't like operating income to decrease. Or 1%, as the increase in net sales was more than offset by a decrease in operating margin. What's that tell you? Their operating expenses went up then, right? Okay? And if you went back and looked at the numbers, you could certainly see that. Net earnings, however, increased a little bit, right? So we got operating income came down a little bit, but net income came up a little bit. So they must have had some extraordinary gains probably someplace. Versus or 3% versus year ago to 14.8 due to a prior year loss. So it wasn't an extraordinary gain this year. It was a kind of a weird loss from last year, right? On early debt extinguishment, lower taxes and interest expenses in the current year. So the taxes went down a little bit and they saved a little bit of interest, probably because they paid some debt off last year early, right? And maybe paying that debt off, maybe they had to incur some fees or whatever for early repayment or something, could be. Okay. So, here in a short little couple paragraphs, I get really a pretty good idea of what's going on with this company. But again, this is just 1 year, okay? I want you to look at it for the 5 years that you can, right? When you go back and you look at those statements, okay, PDFs, the 10Ks or whatever from this company. And in some cases, like if something recent happened that was extraordinary, you might want to go back and look at that quarterly. You might want to go look at that 10Q. Okay, if something popped up and jumped at you, okay, and in many of your cases that that didn't happen, but maybe in some cases it did happen. Okay, you might want to take a look at it. Does that give you a little bit more nuance, a little bit more information about kind of where to go with this? How to do your research a little bit. Again, this is 100 pages long, but I can narrow my search down pretty good. This gives me a pretty good deal of information. If I scroll down a little bit further too, this is obviously on the income statement. So I should scroll down and say, somewhere's down here I'm going to get a breakdown of operating costs, segment results, that's fine. But if I keep scrolling, I know I'm going to get to, here's cash flow. Okay, I might want to stop and take a glance at that. Because remember, we talked about cash flow. Then I get some liabilities. Right? Okay, it's going to talk a little bit about some liabilities maybe. Okay, that I might want to take a look at. Again, there's a lot of little things in here too because they talk about all their different divisions and whatnot that they have. And, if something was really extraordinary in there maybe, but they would have pointed that out up above, and then I might have to go dig a little bit further to see what that was. Okay, but only if something was really extraordinary there. Okay, Michael's going to have all kinds of stuff. He's got UAL. Okay, he's going to have 2 or 3 years there, or 2 years probably, where it's COVID. Okay, it's going to be COVID, right? There may be some other things in there, and so you need to kind of maybe dig those out if there are some other things in there. But I mean, he's going to go 2019 was fine, and then 2020, it all fell through in terms of income going down, but then they got some bailout money too, and so that's probably going to appear on Michael's income statements, right, for UAL. Okay, and it's going to tell that in the same place where I was just kind of looking. It may not be on page 17, it may be on page 19 or 20 or something like that, but it's probably going to be in that area. Okay, let's go through chapter 15 a little bit kind of quickly, because I'll give you a little quiz on this one. Investment banking, public and private, and I just kind of want you guys to get a good sense here of what goes on when companies do decide to go public. It's probably not something that you'll deal with maybe, other than like investing and whatnot for either yourself personally or for the company that you may work for, right? Because they may have excess funds. In the bank, especially at certain times of the year, we'd have, even back in my day, anywhere from $20 to $30 million sometimes that had to be invested, and what do you do with that? Banks were kind of limited in what we could do with it. There's a lot of rules that, unlike FTX, we couldn't go out and buy a lot of equities and things like that. We had to be pretty focused on 100% guaranteed types of government bonds, those types of things. But there's been some interesting things that have happened here in just the last little bit that I think we can talk about here. So what's an investment bank? They're typically bigger banks, Goldman Sachs, JP Morgan, Morgan Stanley, that put together deals when a company wants to go public. Okay, so when a company does want to go public, they're the ones that kind of put that together, and we'll talk about how they do that, the functions. Dilution of earnings is when we get many more shares out there, and I've talked about it in terms of those stock options and how those can cause dilution of earnings. But dilution of earnings happens any time a company may issue more stock, okay? And That happens. In 2007, 2008, when we were going through that financial crisis, a lot of companies issued more stock in order to stay sound. Okay, they had to. Even though they had to sell the stock at very low levels because the market had come down, they just had to do it in order to stay solvent. So then we'll talk about public versus private. And this is what's been going on here lately that I think is kind of interesting. We can talk a little bit about it. Leveraged buyouts, maybe a little bit. What do we call the U.S. Central Bank? We already got that, right? It's the Federal Reserve. Okay. What's the law that created for banks the separation policy of the Depression era? It was called Glass-Steagall. Okay. And what's interesting about the financial crisis of 2007, 2008 is I think it was in 1999, they kind of broke down Glass-Steagall a little bit. They diminished its impact. And so banks, what Glass-Steagall did was it said, if you're a bank, you're a bank. Okay? If you're going to do some other things, that needs to be over here. That's completely separate from the banking side of the business, right? Okay? That kind of diminished, and they started to allow banks to do more things and get involved in some other things. And that's part of what happened with the financial crisis in 2007, 2008, 2009. You guys were all too young. Mary Ann and I remember it well, but you guys were all too young to probably. Oh, yeah, yeah.
Because they set it up after the Depression to prevent what happened in the Depression.
Yeah.
And the same damn thing happened in 2008.
Created a bubble, and the bubble burst, and we ended up with the Great Recession. So, yeah. Investment bankers, again, I'll try to whip through this a little bit, give you guys a little bit of time to work on your projects. I can come around and help you if need be, but so they're the ones that companies over here says, we're getting big enough here, and we're thinking we want to go public. We want to raise some money because we got some more things that we want to do, and we need some money to do that. That might be one of the reasons. It might just be that the owners have been busy and they've done a lot of this, and now they want to cash out a little bit. Okay? They want to get some of their some reward for their hard work. Okay, concentration of capital. Allows large firms to take some additional risk, according to, nothing much there, I don't think. See, then we had, in 1999, the Gramm-Leach-Billy repealed the separation policy of the Depression-era laws, so, which included separating bank, brokerage, insurance, and investment banking into separate entities. So those things kind of got combined, and that's what happened then in the financial crisis of 2007 and whatnot. A lot of these banks then were actually actively investing in derivatives and CBOs, collateral-backed obligations, MBSs, mortgage, just different things that they didn't do prior to and weren't allowed to do prior to this Gramm-Leach-Billy Act. So the Federal Reserve and the Treasury, certainly they have the power to impose restrictions. Okay, banks are heavily regulated. They have been since the Depression, since the run on the banks in the Depression. And they've been heavily regulated, and when we relax that a little bit, then we cause some problems, right? It does say it allows, that's kind of interesting, it allows strong banks to participate in the venture capital market, which is kind of interesting. So they can get out and do some kind of crazy things.
Well, if you have, and then you have $1 million sitting in a bank account, why shouldn't you? When you're dead.
Right, and
Even
that's,
though you have all this money in the bank, so you should be able to take some of that.
put it in more risky assets, yeah. And that's,
Retain enough to cover.
right. And that's often what they look at is the capital requirements. Banks are one entity that, if you think about it, a bank needs absolutely zero equity to conduct business, okay? I can take Mary Ann's deposits and lend them to Michael, okay, day in and day out without exposing, okay? And so technically they could get by with zero capital, but the government imposes a capital requirement on them. There's different ways of calculating it, and I'm not even as an ex-banker, I'm not even sure how to do it all because I didn't get into it that much that side of the bank. But generally speaking, it's somewhere between about 8 and 10% capital requirement. Okay.
And the problem comes in when Marion says, I need my $1 million, please, and we don't have it.
Yeah. And that's where the Federal Reserve comes in and being a member of the Federal Reserve, because that does happen. And to prevent that, if you're a member of the Federal Reserve, you call up the Federal Reserve and say, Mary Ann wants her money, and we don't have it because we've lent it to Michael. Can you float us a quick loan? And they would, okay? And so that's kind of why you want to be a member of the Federal Reserve. if you're not a member of the Federal Reserve, and we weren't, you set up relationships like that with other banks to kind of cover that. But this is what we had before 2007. This is what we ended up with after 2007. Is kind of what they're saying there. So. Yeah, the Dodd-Frank, my banker friends, and I kind of refer to that as Franken-Dodd instead of Dodd-Frank because it kind of imposed some pretty weird restrictions, but we'll probably teach a whole semester on that too. Okay, investment banking, there's competition. It's mainly amongst those, 4, 5, 6 really big banks, I imagine smaller offerings probably go through smaller banks too, but in terms of big offerings, it goes through, J.P. Morgan, Goldman Sachs, one of those probably, right? Citigroup, yeah, Bank of America. Lehman was involved in that, but Lehman actually went broke in 2007, 2008, got absorbed by another company. So what do, right? Okay, they call this an underwriter, a market maker. We'll talk about each of these, a little bit of client advisor, and then agency services to corporations. So it's an underwriter, okay? They give the firm that's doing an IPO a firm commitment to purchase those securities. So XYZ company is going to go public, and Goldman Sachs says, we think your shares are worth $20 a share, and so we guarantee you're going to get $20 a share for those, okay? And then the shares go public, okay? And if the shares do better than $20, that's a good thing, right? If it does less than $20, Goldman Sachs has to step in and come through. Now, Goldman Sachs is going to lay that off. We'll talk a little bit about that. They assume the risk of the distribution, okay? Smaller investment houses may handle distributions for unknown corporations or smaller companies that may want to go public, right? Okay. And that's often done on a commission basis, meaning that they're smaller, they probably can't afford that risk of committing to purchase all of XYZ Corporation stock, when they go public. So instead, they're going to do it on a commission and just say, we're going to get you public, do all the work it takes to get you public, and we're going to take a couple of a percent, something to that effect. So they first do the research, right? Okay, in order to go public, you got to submit a lot of research to the SEC. Your financial statements for the last several years, and they better be audited, and they better be all those things, okay? And the company, the investment company, if they're going to determine what that price is that you may go public at, okay, they got to do a lot of work. They don't want to say it's going to be $20 and we guarantee you $20, and then it comes in at 10. They're going to lose a potload of money, right? And so they got to do their research. They got to know what's going on, et cetera, et cetera. And sometimes the market can fool them too, right? I mean, the market may be going huckle-de-buck, and they're going to do this offering a month from today, and then all of a sudden the market goes poof, and it can be a little bit scary. So advisors, right, they tell them right, types of securities to be sold. Generally, in this case, we're talking about common stock, okay? And again, preferred stock's pretty unusual. Could be bonds, though, too, right? They could issue bonds. Right out of the gate, issuing bonds is a little, that just doesn't happen. That's better for more established companies, okay? They could issue bonds. That said, a company could be well established as a private company. They might be very well established as a private company. There are private companies that issue bonds, and we may talk about some of those as we go along, too, right? Okay. Number of shares, right? Timing of the sale, all those things, right? I don't know if you can read that. It says, Homeville Bank, today's high 80 degrees. Readers are cautioned not to place, I can't read it either, not to place undue reliance on these forward-looking statements when, recent management, something, only has the date hereof. Oh. Yeah. Recent statements, reflect, okay, it's the disclosure, right? So an investment banker may act as an agent for a corporation that wishes to place its securities privately. Do companies place their securities privately then? Yeah, that can happen in big ways. And what's that mean, right? Could be through an insurance company, a pension fund, or a wealthy individual, or give you one. I looked it up because I was trying to remember it. So it was a modest amount in the scheme of things. In 2007, Microsoft invested, this was before Facebook went public, Microsoft invested $240 million in Facebook. Here, Microsoft, you guys don't remember this because you're not old enough, but Microsoft originally tried to enter this space, the social media space, with a product called MySpace. It failed miserably. You know, Facebook came along and just basically replaced it. Well, then Facebook was going along, and Microsoft, even though they had failed in that same space, gave Facebook really some seed money. This was kind of when Facebook was just coming along. It was kind of interesting. It valued the company at $15 billion at the time, okay, and the company ended up with a 1.6% stake. Facebook, even now, Facebook's just gotten hammered in the last year, but even now I think its market cap's over $300 billion. Okay, so Microsoft's 240 million stakes, worth really fast math, 4 to 5 billion, something like that. So, if they still own it, and I'm not sure if they still own it or not. This is dated 2017 or something because it says 10 years after or something like that. So, yeah, but if they still own it, it's that full stake. You know, it's worth something like that, even though it's gotten hammered in the last year. So. Somebody arranged that, right? It's probably a broker, an investment bank that went out and said, you know, Facebook didn't want to go public yet. You know, they just weren't ready to go public, but they needed some money to keep growing and expanding and doing those things. And in that case, Microsoft gave them that money. So you got, you know, corporation, right? In this case, additional shares, which is secondary offering, then it wouldn't be a primary offering. Much the same, but a secondary offering should be a little bit easier because those stocks are already being out there traded, and so the value of it's kind of basically established. I don't know that they go through a lot of underwriting when it's a secondary offering like that.
Would they ever do like,
Right.
but if you do it a little at a time, million shares.
Yeah,
So can you do like 250,000?
sure.
And then 3 months later do another 250,000?
Yeah. Yep.
Because you
That
don't
would,
want to, you have a million already out there, you don't want to just dilute it down, so,
yeah.
but then that you would keep your.
Or you may want to time it a little bit. You may want to time it a little bit for when the market goes up. Then you sell it because you get more money then to run the company, right? So you may do some timing. We'd actually talk about that here in just a second. So, yeah, yeah. Principal so you got Goldman Sachs that's doing this, but you get some big companies that go public. I mean, they may be tens of billions of dollars worth in their initial public offering because they've already established themselves. They're doing well. They're making some money. You know, maybe Goldman Sachs can't even underwrite that, or they don't want to take on all that much risk themselves. And so they call other bankers. They call J.P. Morgan, and they call, you know, Morgan Stanley, and they call these other companies and say, you guys want to participate, okay? We're doing all the footwork, but we're going to give you guys an opportunity to participate. And obviously they got people that do the research on it and on and on and on, right? So then it creates a syndicate, basically, that's going to take care of that. And what do they get? How do they get paid? In this case, they get paid by an underwriting spread. So, again, I'll pick on Goldman Sachs. So they say XYZ company is worth $20, okay? And to us, it's worth 20, okay? And what do they get then? Well, they get a certain number of shares, basically, that kind of an option, I guess you could call it. So those shares are going to sell initially. If they sell for $25, Goldman gets to keep the 5. Okay? If they sell for $20, Goldman gets nothing. Okay? If they sell for 19, Goldman's got to come up with some money, right? Okay, so they got to be pretty diligent in their review and what's going on. Okay, the syndicate, you know, the other ones out there, they get somewhere in between. Okay, so if Goldman says we're going to guarantee 20, they think it's going to go for 22. Okay, and they may get these other syndicate. There's an example coming up right here, right? So price, the managing investment. So if they're going to sell their rights basically to some of those initial stocks to others, to dealers, okay, they're going to sell it to them for $20.75. if those rights get sold to the public, or the stocks actually get sold to the public, it's $21.50, right? So these other syndicate members, then, they pay $20.75, so they might make 75 cents a share, whereas Goldman's making, $1.50 a share, okay? And oftentimes, we're talking about millions of shares that are going out, so lots of money, okay? Then there's dealer groups, and they may make even a little bit less, okay? And what they're doing is they're just acting as agents for some of these syndicate members and whatnot, the dealers are. And then the broker just gets a commission, okay? So again, pricing it, we've kind of already talked about that. And I mean, the processes that they go through, generally speaking, just like you would appraise a house, you go by what other sales are taking place of similar type houses in similar type areas, and you make comparisons based on that. And that's basically what they do, okay, when they're looking at these things in the marketplace. If there is something similar, when Facebook went public, it was kind of breaking new ground, right? So a little different. Pricing it, right? Tentative price is assigned. We don't know what's going to happen in the marketplace. You'll see initial public offering some days, they'll double that first day, boom. And we think it's going to go for 20, and all of a sudden it's selling for 40. Now, did Goldman Sachs sell all theirs at 40? No, they probably sold it on the way up, okay? They probably sold some right away, make sure they get their money out, right? Boom. Yeah. Yeah. Get all your gas cans filled up before Memorial Day weekend, so, right? So under pricing, they set the price slightly below the current market value because they want to make that spread, right? They got to have a little bit of spread there, so. Dilution happens, we've already talked about that, when you get other shares out there, okay? And again, that can happen in terms of stock options too, to your employees, and they got to do that, so. The market stabilization, that's where these companies and, this syndicate then comes in, okay? Because they're going to be buying up these shares if need be to stabilize the market, okay? So if the price starts to go down, they'll jump in and actually bid and pay for those stocks. They're going to end up owning those stocks then. But what's that do in the marketplace? Oh, somebody's buying the stocks for $20. It must be worth $20. And so hopefully that gets other people then buying the stock, right? Research shows that after the IPO generally tends to perform well in the immediate aftermarket, which means in the next month or two, but 3.4% lower than returns for over the first full year. Okay, so oftentimes IPOs, yeah, they go boom, and then they kind of come back here and kind of go like that. Okay, so investors often that can get right in on the front edge, and who are those? They're big. Yeah, that's Vanguard, Fidelity, and those types of places that have that run a lot of mutual funds and whatnot, because they're going to be doing billions of dollars. You and I aren't going to get in necessarily on that IPO. Shelf registration, that's kind of what you were talking about. So you say to the SEC, we want to authorize up to 100 shares, 1,000 shares, 10,000 shares, but we're not necessarily going to sell them tomorrow. So up to 2 years, okay? So we can get 10,000 shares or on the shelf, but then we're authorized to sell those over that next 2 year period of time. We might want to do some market timing, some things like that, so, yeah. But oftentimes used with debt issues too, but it can be common stock, but debt issues is pretty common. Debt issues being bonds. Again, bonds synonymous with debt issues there. So public versus private. What company recently went private? Huge company. Twitter. Yeah, what happened there? Twitter, you and I, a month ago, we could buy stock in Twitter, right? Can we buy stock in Twitter today? Huh. Because Twitter is owned by Elon Musk and some others. I think there's some others that did keep some investment in that, but he's the primary owner of it. Okay. He financed part of that. I'm sure he had to use some of his Tesla stock for collateral and this and that, right? Okay. So companies go private. Big companies sometimes go private. Dell Computers was a private company for quite a while, and then Michael Dell took it public, and then he didn't like what was going on, and so what did he do? He bought it back. He made it back to a private company. I think they still are a private company. I think there's actually a tracking stock that you can buy, which is kind of an oddball thing, but So what's some advantages of being private? Well, yeah, you can do what you want. Guess what? The stocks that you guys are looking at that I signed or that you guys chose for this last paper, it's public and it's, you guys have access to all that information because it's public. Lon doesn't have to tell us anything, right? Nothing, okay? So we wouldn't be able to do this paper on Twitter in 2 years, right? Because it's private. He doesn't have to report to the SEC, okay? So kind of interesting, right? Could Twitter issue bonds? Yeah, sure. Okay, and so private companies can issue bonds, and maybe they've got a good enough reputation. Now, if they do that, that's a security, though, and that kind of gets back to this a little bit. Then they're probably going to have to start complying with some of these rules and regulations. So, might be reasons that they wouldn't want to issue bonds. What could they do instead? Go to J.P. Morgan and borrow money, right? Go to a regular bank like you or I would and borrow money, right? So, advantages of being public, you got access to a lot more money. Is one of the bigger things. For your shareholders, it's because there's liquidity. Meaning, okay, I've got Apple. I can call my buddy, the broker, today, and I could have that Apple sold in 2 seconds. I mean, literally while we're on the phone, he can push a couple buttons and say, yeah, it happened. Okay. I own a few shares still in my old bank, Independence Bank, right? Okay. It's not public. Okay. If I wanted to sell stock, the stock that I have in Independence Bank, I could start calling around, asking people if they might want to buy it. Bank might, oh, Mary Ann wants to buy it. It's not for sale, sorry. Yeah, so it's a little more difficult. You know, my first call would be to the bank and say, you know anybody out there that's got an interest in buying some stock? Because they probably have a list of potential shareholders, right, that may want to purchase stock, so. Yeah. Liquidity for the shareholders, et cetera. Disadvantages, right, it's all public. You got to make all the disclosures. Tremendous pressure. It's quarterly, quarter to quarter. I don't know if you guys followed Salesforce. I didn't follow it a lot, but they've been in the headlines, in the financial headlines the last couple of days because their earnings were crap. They just went to shits. Is the nice way of putting it. And guess what? CEO, I think, just resigned or left or retired or whatever. The CFO, I think 2 or 3 of the top executives anyhow bailed out. And that happened at several others, right? Companies too, right? Underwriting spread, yeah. Public offerings, right? Issue shares to the public, kind of talked about that quite a bit. You'd have to create that prospectus. That's just a chart showing that Rosetta Stone was going to do an offering, secondary offering announced, withdrawn, boom, and then it just kind of didn't do so well. Rosetta Stone didn't. So private placement, we've kind of talked about that, who that could be through. The reason insurance companies, again, they got all that float money. You know, we pay for life insurance, but we don't expect to get that money back for 40 or 50 years, right? So the insurance company gets to play with that, and they invest it. And they can invest in some things like this, right? They're highly regulated, though, too, through states mainly, I think. One thing that's come along, probably be on the quiz on Thursday, too. It's not on here because it's fairly new. It's called SPACs. Special Purpose Acquisition Corporations or companies. And it's kind of a way to avoid some of this investment banking stuff. So a SPAC creates a company, and maybe it's just cash. Maybe they got investors and they put $1 million in here and they create this SPAC, right? Well then, and they get authorized through the SEC because it's pretty simple because, hey, I got $1 million and I don't have any debt. Here's my prospectus, okay? And they get authorized. But then all of a sudden, and I think Trump's Truth Social is going through this process maybe. I don't know if it's public yet or not. But then you've got this company that's a private company, and so you avoid a lot of this hassles of the investment banking and stuff by the SPAC merging with the, well,
When you're investing ahead of knowing what they're going to invest in.
it's just a little bit of a way to avoid some of the stuff. Well, would I invest in something that went that route? No. Okay, but
Why would you do that?
Yeah.
You're giving your money to a
Let-
company that's going to invest it in something, they don't even know what they're going to invest it in yet, so it's.
well, it's let the buyer beware. I mean, they're generally speaking, they're not trying to raise a lot of money in that case then because they're not going to outsiders to raise money. They're just creating this public company then that's going to trade on the secondary market. okay? So, I mean, you gotta have different reasons to go the SPAC route than going through the investment banking route. But yeah, I wouldn't invest in a SPAC company, you know, for several years. After a few years, then you get to read how the company's doing and understand it and get to know it, right? Going private, we've talked about that. Methods of going private. Leverage buyout just means you use the assets of the company that you're buying as collateral, right? No doubt, when I said Musk used Tesla stock, I'm sure that also the assets of Twitter were used in some of the financing that they got. Okay, and that would be considered a leverage buyout in that case.
Wouldn't he have just bought the stock? Isn't that what
Probably,
it is?
probably.
You have stock and I want your company,
Yep.
so I'm just gonna, I watch it
Yep.
pretty good.
Yep.
The guy just buys all the stock in the company, and then he goes to the board of directors and he says, ha, I now own 75% of the stock, you work for me.
Yeah, yeah. It doesn't, in real life, it doesn't work that way often because anytime you get over, or I think over 10% ownership in a company, guess what? Then if you want to buy, sell, or trade any of that stock, you got to report that to the SEC. Okay? And so the company knows that you're out there buying it up because you have to report that to the SEC. That's an issue that Buffett deals with a lot because he buys stock in other companies. He owns outright a whole bunch of companies, right, that they own outright, 65 or 70 companies they own outright. Brooks Shoes, Flight Safety, Dairy Queen, on and on and on. But then also, he's a major stockholder in Apple. We've talked about that. Major stockholder in Wells Fargo. Coca-Cola, huge stockholder in Coca-Cola. And so anytime he wants to buy, sell, or trade those, he has to report that to the SEC. So. And I don't even think he owns 10%, but I still think he's considered a big enough shareholder that he has to report a lot of that stuff, so. Privatization. So there you go. Okay, I talked enough, used up most of the time. Be a little quiz on that, though. For sure I'll have SPAC on there on Thursday, so. And then, yep, I'll post the PowerPoint for sure, so you guys can have a look at it. And, then Thursday, we'll finish up touches, probably. I don't think I had any more chapters I really want to talk about. I'll take a look and make sure, but, I'll finish up touches on going over papers, you know, any questions you guys might have, et cetera.